Let's look at another example here. We've got Willie's Construction begins operations in March and has the following transactions. So what I want you to do is just pause this video, take a few moments, and see if you can come up with the journal entries for each of these transactions. And then we'll continue and answer them together. Alright, so hopefully you paused and have this finished a little bit. So let's start with March 1st. On March 1st, it says that we issue common stock for $25,000. So again, what are the two things being impacted? One, common stock, that's what we're issuing. And two, we issued it for $25,000, so that means we would receive cash. So since cash is an asset and it's increasing, we're going to debit cash for the $25,000. And then we are going to credit our common stock for the same $25,000. Once we've done that, what is the actual impact of the financials? Now, I'm not going to put the numbers here, but I do want you to. I just don't think I have enough room. Well, one, cash and common stock. Are either of those classified as revenue or expense? Absolutely not. So the income statement is not impacted. So we know that the balance sheet is going to, one, our assets is going to go up by 25. So again, if you don't mind putting 25,000 in there, mine's not really going to fit. So I'm going to pause there. I'll just put the positive 25. And common stock is part of equity. So our equity again is going to go up by the 25. So again, just write in plus minus 25,000. And that'll help us keep that a little more organized. I'm going to leave out the zeros simply because I don't have room here on my space. All right, moving to the next one, March 5th. So what's happening on March 5th? If we look, we see we purchased office equipment for $5,000 cash. Again, pick out those things that make sense. What are we buying? Office equipment. How are we buying it? With cash. So that sort of tells us the two accounts that are going to be used, either office equipment or equipment and cash. So let's talk about each of those. Office equipment is an asset. Assets are going up. So to take an asset up, we would need to debit the account. So again, office equipment, or if you just typed in equipment there, perfectly fine. And that's going to be for $5,000. And then what are we offsetting that with? Is going to be cash. Cash is an asset. Since we're spending our cash is going down. So that would be a credit. So again, how does that impact the financial position of our company? Both of these are assets, so that's sort of neat. One, our assets are going up by the $5,000 in the purchase of equipment, but they're also going down by $5 because we're spending cash. So this is known as an asset exchange. We're exchanging one asset for another asset. Again, why do we look at this? Well, this allows us to make decisions. When we understand the impact of transactions on the financial performance and position of our company, it becomes easier for us to make decisions. All right, next, we're looking at March the 10th. March 10th, it says paid rent on office space for the month. That's important. We're only paying the current month's rent, $4,500. So what are we paying? Rent. Now, when we talk about rent, there's two options. It's either prepaid, which means we paid rent for the future, or it's an expense to us because we paid for the current period. Well, in this case, it's going to be rent expense because it's just for the current month. So our expense account is going up. How do we increase expenses? Well, at this point, you know that those are debits, so we're going to debit our rent expense for the $4,500. Now, what else is going on? Well, what is offsetting this? How are we going to pay for it? Well, there's really only one way you can pay for something, and that is through cash. So our cash is going down by $4,500. Now, let's talk about the income statement and the balance sheet. How are they being impacted? Well, an expense account, definitely here. Income statement, we've got an expense. Our expenses are going up by $4,500. When expenses go up, what happens to income? Very good, income goes down. So we're going to take our income down by 4,500. All right, now on the balance sheet, what happens? Well, again, since income's coming down, so is equity. When net income goes down, our equity of our company also goes down. What's going to offset that? Well, cash, and cash is an asset. Cash is going down, so our assets are going down. Notice every transaction has dual effect. It always maintains the equation's balance, which is very important. All right, so now move this on down so that we can see our title there. Okay, So now, March the 15th, I think, is the next transaction. March 15th, we purchased equipment for $30,000 by placing $3,000 down and securing a bank loan for the balance. Very interesting. Notice it. Record each transaction. Willis uses the following accounts, but notice equipment wasn't in there. That's the reason we've added that equipment account. So let's talk about what's going on here. One, we purchased equipment, so our equipment is going up or down. It's going up, so we're going to go in and we're going to credit our equipment. Now we're going to keep this separate from our office equipment, or if you use the same account, that is perfectly fine. We're adding these accounts to our chart of accounts because they did not exist before. This is equipment used in our operations here, and we're buying it for $30,000. Now what's offsetting that? Well, there has to be a source in order to purchase that equipment. So one of two things: we either bought it on account, signed a note, or paid cash. Well, in this case, we did two things. One, we placed $3,000 down. Well, when you place a down payment, that means you are putting cash down. So our cash is going to go down by $3,000. Then it states we secured a bank loan. So we signed a bank loan for the remainder balance. Now, in that, it would either be an accounts payable or a notes payable. Accounts payable is typically very short-term verbal agreements. Bank loan, though, indicates that this is a securing of a bank loan. We would have signed a document. So in that case, I would use a notes payable. Okay, so we're not buying it on account, we're securing a loan for it. So the $27,000 remaining balance actually comes from a note, not cash. So the cool thing here, this is known as a compound entry. So we've got simple, which means there's one debit, one credit. And then we have what we call compound entries, where you have one debit with multiple credits, or multiple debits with a single credit, or multiple debits and multiple credits that balance out to make that transaction work. So we are allowed to use more than two counts in a transaction. That's known as a compound transaction there. Notice, though, the debit goes first, followed by all the credits. Now, you could flip these. You could put the note and then the cash, and that would be perfectly fine. There's no issue with that. But this sort of gives you the format of that entry. All right, so our income statement, is it impacted? Well, we've got equipment as an asset, cash as an asset, notes payable is a liability. So again, income statement is not impacted by this transaction. However, the balance sheet is impacted by every transaction that we record. So in this case, our assets are going up by 30, again 30,000. Our cash is going down by 3 because we're paying cash out. And then our liabilities here are going up by 27. You're like, wait a minute, are we in balance? Absolutely. Notice the change in assets. Assets equals liability plus equity. Our change in asset is 27 on this side, the left side of the equation, equals liabilities and equity, again, going up by 27. So the net impact is equal. We just have more than two accounts being involved there. Very good. All right, moving on. Let's look at March the 22nd. March 22nd, we provide construction services for $15,000 on account. Provide services. Remember, anytime you see those key words, we have performed a service, that meets the definition of revenue recognition. Remember, revenue recognition is we recognize revenue in the period in which the obligation is complete. In other words, when we provide or complete those construction services, that's when we get to recognize revenue. Revenue is going up here because we've earned it. Therefore, it would be a credit. So now the payment method, one of two things. Either our customer owes us money, we call that accounts receivable, or they've paid us in cash. So which is it here? Well, obviously it's on account. We didn't receive cash, so it's going to be called an accounts receivable here. And our accounts receivable is our debit because it's an asset going up for $15,000. Now, what's going to offset or go against that? In other words, what is our offsetting event? What's the source of that? Well, it's going to be our service revenue, as we described a moment ago, because we performed the service. Again, revenue recognition in its basic form, most basic form, is we get to recognize revenue when the obligation is complete. In other words, when it's earned. All right, so let's walk through. Did we impact the income statement? Yes, revenues are impacted, so our revenues are going to go up. When revenues go up, our income goes up. So revenues up, income up. Expenses up, revenues down. And that is, again, anytime our income is impacted, so is our equity, because revenues and expenses are part of retained earnings, which are under equity there. Then accounts receivable is an asset, and it is also going up. So again, our equation is still in balance. All right, continuing on, March 27th. March 27th, we pay salaries for the current month. Salaries to a company would be an expense. Very good. So our salaries expense is going to go up. Expenses are debit accounts because they're reducing equity. So salaries expense goes in there as a debit of $15,000. And then if we go into our offset, we pay salaries, so that means that we're going to hit cash for $15,000. How does this impact our financial performance and financial position? Well, expenses are being impacted, so therefore our income statement, our expenses are going up by 15, which means our income goes down by 15. As our income changes, so does our equity. So our equity also will match that with a negative 15, a reduction in our overall equity. Our cash is also going down. Cash doesn't impact the income statement, but it does impact our balance sheet. Our assets are going down by 15. All right, and the last transaction, March 28th. March 28th, we received $15,000 cash from the customers on account. Now remember, what that means, we're not providing more services. Remember back on the 22nd, we provided services to our customer and we billed them for $15,000. Here, those customers are simply paying off that account. So we're receiving cash, so cash is going up by 15. And since we're receiving it on account, that means the customers no longer owe us, so we need to reduce our accounts receivable by that same $15,000. How does that impact our financial performance and position? Well, asset. Would our income statement be impacted? Absolutely not. That transaction will have no impact on our overall income statement. So what about our balance sheet? Again, these are two assets. Our cash is going up. Our receivables going down. This is simply an asset exchange again. All right, we have now recorded all of the transactions for this company. So let's sort of look here so you can see the entire effect. Pretty neat. Hopefully this matches the solution that you had prior to watching this video. If you have any questions, don't hesitate to contact me. Have a great day.